Good afternoon, everybody. Today is Friday. It's the 25th of April, 2014, and this is Brian Shannon speaking from alphatrends.net. Hope everybody made it through this week okay. We did have some volatility, and actually the S&P 500 and the Nasdaq only lost a small amount this week. The Russell 2000 did have a bigger loss, and as did the semiconductors, but it was pretty volatile. So let's take a look at the sectors and see where we are. Let's start with the S&P 500 like we always do. A week and a half, 2 weeks ago, we had broken below this larger level of support between 184 and 184.5, and that put us on a real defensive stance, saying that we wouldn't trust the market on the long side until it got back above that level and until it got above and held above a rising 5-day moving average. Well, we saw that happen this week, and then we saw the market, of course, run up beyond this prior little resistance at 187, and this was what I've been referring to as the key in the near term to the basically the intermediate term trend, that as long as we held above 187, we'd give the benefit of the doubt to the buyers. But of course today we gapped lower. We're now below a 5-day moving average, and that 5-day moving average is declining, so we have to be very cautious once again. We're looking at the daily time frame. You can see we're at the conjunction pretty much here of the 10, 20, and 50-day moving average, and that is the potential for support. But as we know, it's only a potential area of support until we actually see signs that the market is slowing down. It's this decline that we're maybe starting here, that it's not the beginning of something bigger. Right now, we have to look at this market and say this is our band of resistance, basically 187 to 187.5, and we're going to need to see it get back above there next week before we can trust the long side once again. So we have to go into next week with a very defensive posture, and we are still in the middle of earnings season. This week saw the heaviest release of earnings, but we still are going to be seeing a lot of earnings reports next week and the week after that. For the Nasdaq, which was down $1.40 today, we had been cautiously optimistic and looking at this as a potential level of resistance. We did see, though, today that yesterday we gapped above it and then pulled back a little bit, but back today we broke the near-term level of support that we wanted to see hold, and we're back to a very defensive posture here as well. We did break the pattern this week of the lower highs and lower lows that we had seen, so these lower highs were broken. However, right now what we need to see is that the market can pull back and find some stability. So as I always say, we have to ask ourselves two questions when we decide whether we're going to purchase or not. And yesterday, for instance, breaking beyond that 88 level, the question was, where has it come from? Where did it have the potential to go? It has just come from 83.5 up to 88.5, 88 and a quarter or so. Is that the smart buy? Generally, it's not. So we have to go on defensive. And when the market broke down below the volume-weighted average price and held below it, that told us it was time to look at this market much more defensively. That, of course, happened today when we lost this $87 level as well, which is where we have that rising 5-day moving average. Actually, I'm sorry, the 5-day moving average is starting to flatten out. So now when we look at the Nasdaq going into next week, we have to look at it again as the bulls have something to prove here, not the bears. The sellers are in control of the intermediate term going into next week, and it's going to take a move above 87 that holds for more than a half hour or so. If we can get back above 87 and hold above it, then perhaps we're going to see that this market can go on and break beyond that 50-day moving average. But with the 50-day moving average now declining, it looks a lot less likely that that will in fact happen, and perhaps we're headed back down to test that 200-day moving average and the lows that we saw a week and a half ago. The point is we don't know, but what we can do is manage risk, and people are learning, I think a lot of people are learning, that risk management truly is job number one. When you see stocks like Netflix report earnings and we have a declining 50-day moving average and people get excited about it, you have to ask yourself again, it came from 312 up to 380. Who is going to buy up there after a 60-point move in a market with a declining 50-day moving average? It's just generally not smart. And then if you're looking for where is the support, well, we have lower highs and lower lows in Netflix. Now, maybe next week Netflix gets a little bit of a bounce, but we've got a very badly damaged stock here that when we look at it on a weekly time frame, perhaps we're going to find support in here, but the burden of proof is truly on the buyers in these markets. Of course, Apple was the exception. Apple broke out this week. on earnings. And what I think that we have to look at Apple is now the buyers are clearly in control, but do you want to buy up here at 572? I don't, unless you're looking for a day trade and maybe you want to set your stop at 570 or something. But for a longer term hold, I think you need to let the stock settle down, see where the buyers defend it after a pullback that will be inevitable after a move like this. And if you miss it, then you miss it. The point is there's always another opportunity around the corner, and if you can control your risk, not get emotional and buy into stocks because of something that you believe, then I think you're going to end up saving yourself a lot of money. The Russell 2000 was down $2 today, and for the week, of course, we were down a little bit worse there, and we're down 4% for the month, 3.25% year to date. So clearly, what had been the leader over the last couple of years, the Russell 2000, is now the leader to the downside, and that's something definitely worth noting because it was the Russell 2000 that broke to all-time highs back in January of 2013, well before the S&P 500 or the Nasdaq did. The new all-time highs in the S&P 500 came a couple months later, but they've been it's been the Russell that's been the leader throughout this market, and we didn't see a higher high in this Russell 2000. Instead, we still see these lower highs, and we should expect likely that we'll continue to see a lower low. That's the definition of trend: lower highs and lower lows. And a trend once established is more likely to continue than it is to reverse. What we can do is say, where does it have the potential to find support? Perhaps down near that 200-day moving average once again at 110. The 200-day moving average is still advancing, so perhaps we're going to see just a bigger distribution here over the next several months. But right now, on the intermediate term, we're going to need to see this market back up above 113.5 or so before we can take it seriously as far as a swing trade opportunity goes. This may be a higher low right in here, but right until we see a higher high, it's really pretty meaningless. It's just another pullback. And the burden of proof is on the buyers, so it's guilty till proven innocent. And the semiconductors, which have been the real strong group, they're back down to the 50-day moving average. We can take a look also in here at the volume-weighted average price year to date, because that is showing significance down here at 43.75 basically. 43.75 is where we've found a little bit of resistance that turned into support and then support once again. So 43.75, I wouldn't short it below there, because again, where does it come from? If it just dropped from 46 to 43.75, what I'd like to see is maybe that it comes down to that level, creates a lower high over here, the 50-day moving average turns sideways, and then it begins a deeper pullback. But for now, you have to look at the daily time frame as perhaps under distribution, but still, with a rising 50-day moving average, we can't get aggressively short. Looking at the intermediate term time frame, we'd failed to break this little peak, and today, of course, we gapped lower. Now we're looking to test that bigger level of support in the volume-weighted average price year to date at 44.75. So I think you have to be very cautious there, as you do with the financials as well. The financials made it up to this prior important level, which was highs back in January. So that level became resistance here, and we've really kind of been looking at $21.90. Basically, this band in here had been a prior band of support, which turned into resistance, and now I think back below 21.80 kind of confirms that we're still likely to continue lower here, and it's going to need to get at least back above 22 before you can think that the financials are a good purchase for the intermediate term. So again, this market also is guilty till proven innocent. Looking at the winner here this week, which was the the bonds and gold, basically. The bonds were up 1.1%. Gold was up 0.5%. But looking at the bonds, you can see that they are continuing to move higher above that rising 10, 20, and 50-day moving average. And on a weekly time frame, they've broken some important resistance. So bonds look like, as long as they continue to hold up above 109, and I don't trade these, we're just looking at it because a lot of people like to look at them, 109.5 or so, that the bonds ought to continue to rally, with obviously that meaning that rates are declining. Gold, I don't trade gold either. I don't trade any of these vehicles that gap every single day. I don't find the advantage to them. But gold, this reminds me of the saying. We've been talking about this one, that it's guilty till proven innocent. And if they don't scare you out, they're generally going to wear you out. They don't, these markets don't just typically turn on a dime. It takes time for a market to turn and the buyers regain control. A lot of people are obviously seeing that in some of the momentum names. Twitter, again, it's still in a downtrend. We had a little bit of a pop here that was great for a trade if you were involved, but we're guilty till proven innocent. Twitter's still in a primary downtrend, and if they haven't scared you out of your Twitter position, they'll most likely wear you out, because we have lower highs and lower lows on the bigger picture. Looking at the weekly time frame, we're languishing down near these, near the lows since the IPO. So it remains a very volatile environment. When we have, Google breaking down here today, Google looks like it's probably headed for at least a test of the 200-day moving average. So the leadership just isn't that strong. Basically, what we're seeing is stocks like Coke. We're seeing stocks like McDonald's and Philip Morris. These are the types of stocks that are leading the way, and these are very defensive stocks. When we have that happen, and then we see the stocks like FireEye continue to bleed off day after day after day, and Workday, these types of stocks, they just continue to get crushed day after day. We get small short-term bounces. There's nothing that says these stocks have to turn back higher. They are still in primary downtrends. There's nothing wrong with looking for a bounce here or there, but if you're going to look for a bounce, again, I have to repeat over and over again that it's risk management that's job number one. If you're going to look to buy a higher high above a rising 5-day moving average, you have to set your stop very close by. Otherwise, you're going to continue to face the problems of buying pullbacks, which is we never know if it's the pullback that continues to pull back and destroys wealth, because that's what's happening in stocks like Data, which is down from $103 down to $56 and showing really no signs of slowing down as we closed at lower lows for the week. Now this week in Alpha Trends, I had mentioned last week, I'd sent out an email that Plug Power had the potential to get squeezed. I thought that it had a good-looking chart pattern, and that if it got going above this 740 level, I thought it looked like a good buy. And I had mentioned, been very careful to say, what if the short sellers are right here? Have a backup plan. Risk management is job number one. This was a short squeeze potential candidate. I said, but what if the shorts have it right? And apparently they do have it right, because the stock gapped up that day and it pulled back, and as I told subscribers, this is where we wanted to get out of the stock as it made a new low that day. If you bought the gap up and rode it a little bit, you wanted to get out as it broke a new low for that day, because it said basically the sellers are back in control. And we took a small loss in here, and a small loss is fine. It's these bigger losses that if you continue to hold it here down at $5.40, more than $2 lower, or about 20%, that's a devastating loss, and you just can't be stubborn, and you can't let your opinion get in the way of making money. You can't let your opinion get in the way where it's going to cost you very, very dearly if you're trying to buy this breakout. Breakouts are great only if they hold. If they fail, you got to move to the sidelines. From failed moves come fast moves often. We did catch a nice trade in Amcor this week. Got stopped out of the balance of that one today up here. We caught a good trade in Walmart. However, Walmart, we got stopped out at 78.08 today. So we got involved at $77.76, and we were stopped out today at 78.08. Perhaps I had the stop a little bit too tight, but in this market, you got to be quick to take your profits where they come from. And we're also involved short in UBNT. We're short as of today in Akamai, and there's still a lot of opportunity out there in this market. Perhaps Microsoft is going to recover. They reported earnings, and it did close below the volume weighted average price today. So on balance, there were sellers in the stock today. Even though it was up 5 cents, the average price was transacted at a higher price than where the stock closed. So on balance, the average participant today lost money. Now, if Microsoft can kind of spend some time rebuilding in here, then perhaps it's going to be able to continue to move higher from this nice looking monthly chart. There's a potential scenario. Energy has been strong. XLE is the exchange traded fund for the energy stocks, and you can see here they had a great week and a half or so. One stock that might be a candidate to continue next week is WCC Westco. It's an energy company, and perhaps above Thursday's high it could get going. Worst case stop would be down here. I'm trying to give you an idea of the types of trades that I bring to subscribers each day at Alpha Trends. If you haven't taken a free trial, then go ahead and do so, and you'll see how I would actually trade this stock and how we would I would suggest you manage risk. So hopefully you've got a plan for this market, and you're not one of the people who's just blindly buying into pullbacks thinking that it's okay to buy dips, because that's what you've been trained to do. When the stock is going up, buying a dip is great, but like in LinkedIn, the stock has been in a downtrend. Buying the dip is just kind of dumb unless you're doing it for very short-term trades. That's a different strategy. Have a strategy, know what that is, be consistent, and your returns will be more consistent. That's what I can help you with at Alpha Trends. It's a long week. I will talk to you again next week. Thanks for tuning in.